And thank you all for joining us today. We got a lot of good content and that we're going to try to pack into a pretty short presentation here. So I'm going to go ahead and just dive right into it. We're going to start off, I'll have this broken up into three sections. We're going to start off with all our just key headline indicators telling us where the market's at as we're, kind of starting to near the end of the summer peak season. Then I'm going to go into a little bit of data from the apartment list platform, telling us a little bit more detail about what exactly it is renters are telling us that they're looking for. And then finally, I want to talk a little bit about the for sale side of the market because that's an area where there's definitely has interplay between the rental market and the for sale market. I think the trends on that side have been really interesting over the past few years and want to spend a minute there as well. So starting off with our key rental indicators, let's start with rent growth. This chart is showing month over month rent changes nationally, and you can see it's actually been tapering off for the past few months. So in July, the national median rent was basically unchanged. And that was after the past few months of rent growth really slowing down. So normally it tends to be the case that we see rent growth kind of accelerating through the spring and into the early summer as the peak season moving activity ramps up. This year, we actually saw rent growth peak in March. And for the 4 months following that, we've now seen rent growth progressively slow down. This month, it was 0%, and it's looking likely that next month, rent growth might dip negative. That tends to be the usual seasonality of the market as we see prices increase through the spring and summer, and then slight declines in the fall and winter off season. Uh, as I said, typically, if you look like to kind of pre-pandemic years, it was always around June, July when we would see the fastest rent growth in the year. The past couple of years, we've seen things really start to stall out earlier in the year and those declines come a little bit sooner. So, some of this just has to do with the fact that the market has been pretty soft. But at the same time, I think we might also be seeing a little bit of a shift in seasonality here. The pandemic, I think, maybe having a little bit of a lasting impact on the timing of when folks are moving. So that's something to keep an eye on here as well. So adding up all those month over month changes, this chart is showing year over year rent growth. So how much has the national median rent changed compared to 1 year ago? Right now, the national median rent down 0.8% over the course of the past 12 months. Not a huge change in dollar terms. We're talking about $10 a month here, basically, but still notable nonetheless that it's really not typical to see rent prices actually falling nationally. Certainly not if you look past before these past 5 years of this real roller coaster that we've been on. Prior to that, it really would have been atypical to see prices falling nationally. Now our national index has actually been in negative year-over-year rent growth territory for basically 2 years since mid-2023. It had been starting to creep closer and closer to zero. We thought that it was going to potentially flip back into positive territory during this summer moving season. But now that's actually stalled out, and this year-over-year number has started to dip further negative for the past couple of months. We have been seeing the number of units hitting the market on the supply side as far as new construction. That's been slowing. So the story of this really soft market that we've been experiencing over these past few years, a lot of that's been driven by all of this new supply that's been coming onto the market. We're past the peak there. The number of units hitting the market, that is slowing down. So we were expecting as this construction wave kind of gets past its peak, that we would see rent growth start to pick up steam again. And that was starting to happen. Now the stalling out here, I think, might have a little bit more to do with the demand side of the market. I think it's possible that some of the macro uncertainty that's been introduced into the equation over the course of this year when we talk about tariffs and some of these other policies, a lot of that stuff has just made folks feel a lot less confident in the macroeconomic outlook. that tends to translate to people putting off big economic decisions. Moving, obviously, is one of those big economic financial choices. And so I think that might be what's happening as far as kind of the weak pricing that we've been seeing during this summer season. I think some of that driven by a little bit of softening on demand. Now, overall, demand has still been pretty healthy, but as we're still seeing, even as we come down off that peak, still a lot of new units on the market. I think it's just taking a little bit longer than we were anticipating for all of that new supply to get metabolized and for conditions to start to shift. Now, when we talk about that in dollar terms, this is just what the actual dollar value of the national median rent looks like, the dark purple line there. And comparing this dotted line to where things would be if we had just remained on the pre-pandemic trend. So, 2017 to 2019, we were seeing really pretty boring rent growth, just kind of slow, steady, 2-3% per year, pretty much in line with the overall rate of inflation. Now, obviously, for the past 5 years, that story has really shifted where we've been alternating between period of really skyrocketing rent and now a couple years of much softer growth where prices have actually been trending modestly downward. So, we saw in 2021 and 2022 that the median rent spiked way above the trend that it had been on. Now those lines are starting to converge again. We are still above that long-term trend, though. So even though pricing has been soft for these past few years, median rent nationally still actually a bit higher than it would have been if we had just remained on that slow and steady pace. Of course, tons of regional variation baked in here. So this map is showing metro level rent growth for all of the markets across the country where we have data. And you can see there's despite some exceptions, there's some pretty clear regional trends where it's a lot of the markets in the South, the Sun Belt region that are seeing the biggest declines. Austin, Texas is the prime example of that. The national rent or the median rent in Austin down 7% year over year and down about 17% from its 2022 peak. So, Austin's the market that's been building the most by a pretty wide margin. And that's playing out in terms of falling prices there pretty sharply. But a lot of these markets throughout that region, a lot of the Texas markets, Florida, Arizona, those are the places that are seeing the biggest declines. Whereas a lot of the Northeast, the Midwest, maintaining positive rent growth. And right now, actually, the Bay Area is seeing the nation's fastest rent growth. The median rent in San Francisco up 5% over the past year. I think, the AI boom really having an impact on housing prices there. Now, of course, the Bay Area was also the market that was hit hardest in the early phases of the pandemic. So still, if we look over the past 5 years as a whole, the Bay Area has had the softest pricing over that period in its entirety. But over just the past year, we are seeing a pretty strong bounce back there. Okay, now taking a look at the supply side of the market, this is our national vacancy index. As of July, this has hit 7.1%. That's the highest that we've ever seen in this data series, which goes back to 2017. The previous peak was in early 2020 where it was at 6.8%. So again, we are not seeing as many new units hit the market this year as we saw last year, but we are still seeing, more new units come online than the long-term average. So the peak was as far as all of this construction wave, the peak there was just really high. We're coming down off of that peak, but it's going to take a while for that to continue to fall and for the market to just metabolize all of that new supply that's come online. So we're expecting that into the back half of this year and into 2026, we're going to see that number of new units hitting the market, those construction deliveries, that's going to continue to fall. And as it does, I think there is kind of an inflection point on the horizon here where occupancy and pricing are probably going to start to strengthen again. But we might still be a little bit ways off of that. I think we're probably looking at late this year, early next year when we see things start to shift there. And one final indicator here is our list to lease time. So the number of days that it's taking for units to get leased after they are initially listed as available on our platform. You can see this indicator also tracks these broad macro cycles where in 2021 and 2022, units were turning over really, really quickly. As the market has softened over the past few years, this has this has kind of eased and units are sitting for longer. But now we're starting to get back actually to something that looks a little bit closer to that 2019 and prior average. Right now, you also see just kind of the broad seasonal swings here, where in the winter, when fewer people are moving, units tend to sit longer. In the summer, things tend to move a bit more quickly. In January of this year, this metric was at 37 days, which was an all-time high. It's now been kind of tightening over the course of this year. Right now, we're at 28 days, which for this time of year, that's slightly longer than what we would have seen in 2019, which I'm kind of using as a proxy for a more kind of stabilized market. But we're pretty close to that 2019 level after, again, a few years where things have been a little bit more all over the map. Okay, so I'm going to stop there on our key indicators and now transition into our section on renter search patterns. And the thing I want to start off with here is the fact that renters are just taking their time more so in the past as far as approaching their apartment hunt. Now, this is something where, the apartment list platform is really designed to get to know our renters. We ask folks a bunch of questions when they sign up to understand exactly what they're looking for from the standpoint of a renter using our product. That helps us make really great matches and only show them apartments that they that kind of fit what they're looking for. From the standpoint of the properties that partner with us, that helps us send really great leads. But from my standpoint as a researcher, that gives us a lot of really great data about what renters are looking for. Now, one thing we ask them is how important their move-in date is for them, and that ranges from 1 to 4 scale. I'm just looking. I don't even have a hard move-in date in mind. I just kind of want to see what's out there. 4 being the people that are really moving very urgently. So we combine the 1 and the 2 buckets here and call those folks low urgency searchers. That's what's being shown in the chart here is the share of all of our users that are searching with this low urgency on a 12-month moving average. And right now, that's at 54, which is also an all-time high. What that's telling us is that, there are more folks searching with low urgency than there have been for as far as we've tracked this metric. And again, I think a lot of that comes down to just some of these broader macro conditions in the market right now. There's a lot of units that are available. And so we're in a position still where properties are having to compete for renters more so than renters are having to compete for units. And I think renters are aware of this and they're using all that optionality out there to really take their time and evaluate their choices. So, given that context that renters are really taking their time and seeing what's out there, it's really important to know what exactly it is that they're looking for. And so, thankfully, we have a ton of great data on this too. We break up search preference into 3 broad categories: amenities, location, and pricing. And we ask folks which of those factors is most important to them. The chart here is showing how that breaks down, how that's changed over time. You can see actually it's a pretty stable set over time of folks that list each of these factors as the most important. 60+% tell us that price is the most important factor to them. That's by far the most common response to that question. Around 25% tell us that location is the most important thing to them. And then it's only about 15% that say that amenities is the thing that matters most to them. So that's what renters tell us is the most important to them. But what do we actually see once they get into searching and how do the places that they lease compare to those preferences that they initially gave us? This chart here, I'm showing how the unit that renters leased compared to their initial search preferences into these three broad categories. And so in the chart on the left-hand slide here, each of those columns, the check or the X, tell us whether or not the user had a match on that particular preference dimension. So did they stay under the budget they were trying to be within? Did they rent in the location that they wanted to be in? And did they get all the amenities that they told us that they wanted? You can see the top row there, 43%. The most common scenario is actually what we refer to as exact matches, people that got everything that they were looking for. And the right-hand side of the slide here showing how that's evolved over time. So actually 2024, a little bit of a peak there. Again, I think having to do with all of those new units being online, pricing being a little bit softer, folks being able to kind of take advantage of all those choices. That's now maybe started to come down a little bit. I think again, as kind of we haven't really seen that shift in terms of price and occupancy, but this is one area where having less of that new supply coming online might be having a little bit of an impact. So 4 and 10 renters get exactly what they want, but that still means that 6 and 10 are compromising somewhere. And you can see the second row in that left-hand side chart, those are actually people that get nothing that they told us. So, they go over the budget that they put in, they rent outside of the location that they were initially searching in, and they skip out on one or more of the amenities that they say that they wanted. I think that tells us that, a lot of times renters, when they start their search, they maybe don't even know exactly what it is that they're looking for. I think a lot of times, preferences really take shape over the course of the search. Sometimes you just need to see what it is that's out there before you really know what you're looking for. I think this is kind of an important thing to keep in mind for folks on the operator side that, there really is kind of that sort of education component in selling renters and just helping them figure out what it is that they're looking for. Now the third row here is price. 18% end up in their preferred location with all their preferred amenities, but they go over their stated budget. This is interesting, right? Because on the previous slide, we had almost 2/3 of renters tell us that price was the most important factor to them, but yet it's actually the thing that renters are most likely to flex on. Uh, if you add that all up, it's 43% of all of our users that go over the budget that they gave us. And the median amount there is $220. So we're not talking about someone, going over their budget by $10 a month or something like that. This is a meaningful amount of budget flex that we're talking about here. That varies a lot by region too. In some of the more expensive markets, San Francisco, LA, New York, we can be talking about people going over by 400 plus on average. So, that's another really important thing to keep in mind. Even though renters tell us that budget is the most important thing to them, if they find the right place, a lot of folks are able and willing to spend more than that. And then I want to talk a little bit more about the amenity side as well. So this chart is showing the share of folks, the total bar, the purple and the kind of peach colored segments combined there. That's telling us the total share of all of our users that said that they wanted a given amenity. The purple segment, those are the folks that said that they wanted that amenity and then they leased a place that has that amenity. The peach segment, those are people that say that they wanted that amenity, but then they ultimately leased a place that didn't have that amenity. Now, it actually turns out that, when we look at the particularly on the property side amenities, things like gyms, pools, pet friendliness, most folks are able to find what it is that they're looking for there. There's very few renters that are flexing on those amenities. When you get into the unit level stuff, still actually not very big shares. In-unit laundry is the biggest one. That's actually where we have about 25% of our renters telling us that they wanted in-unit laundry, but leasing a place that didn't have it. So that's the thing that has the biggest flex when we talk about amenities. Most of the rest of these or actually all of the rest that I'm showing here are in single digits. Air conditioning is the second most common amenity to flex on. It's about 8% there. But there too, we're talking about a lot of regional variation. So in places where you really need air conditioning, every place has air conditioning. Places in the Northeast, maybe people in the Midwest, maybe people are willing to flex on that a little bit more. But really, I think my takeaway from this is that sometimes when we talk about amenities, uh, it's maybe just more simple than we think it is. You get into these conversations of, do we need to install a pickleball court or what have you? And that stuff is great, and those are certainly important ways to differentiate. But a lot of times, it's just the simple stuff. Renters want laundry in their unit. They don't want to have to go to a laundromat or go to a shared laundry room. And that's kind of the biggest thing here that we see on the humanity side. And then the last couple minutes here, as I said, I want to just give a quick update on the for sale market. Uh, so as much as we've seen rent prices kind of increase over the past 5 years, that 22% increase going back to the start of 2020, again, even as things have been soft for the past few years, rent price is still higher than they would have been on that pre-pandemic trend. But home prices going much, much higher than that. Growth more than twice as fast as rents nationally. The national median home price up 56% since the start of 2020. And that's before you even incorporate the increase in mortgage rates. And so home prices have become really, really unaffordable in recent years. And what that's resulted in is just this big stalemate in the for sale market. Right now, we're seeing that there just aren't a lot of transactions happening. Not a lot of homes are selling, and sellers are kind of okay, just not selling, right? A lot of people that own homes right now are locked into really low mortgage rates. They're not in a hurry to sell, and they have kind of their mind set on a price that they want to get for their home. So if they list their home and they're not able to get the price that they want, they're okay just sticking in place. And so, rather than home prices sort of starting to crack and come down to a level that buyers would find more affordable, what we're seeing is that there just haven't been a lot of transactions taking place. And so millennials are still, trailing prior generations when it comes to homeownership. This is something that is kind of a long-term trend. There has been improvement in recent years, but we still see kind of a pretty serious trailing here. This is just controlling for age. It was just showing the homeownership of different generations at age 30 for millennials, and age 30 there corresponds to kind of the very youngest range of millennials right now, kind of hitting that age. But this is kind of looking at the entire generation at that age, what their home ownership rate was. And so for millennials, that's just 33% compared to 42% of Gen X that owned homes at age 30, and about half of baby boomers in the silent generation. So millennials still really trailing when it comes to attaining home ownership, meaning that they're staying in rentals for longer. So that's why this stuff is really important for this audience, is that all these challenges on the for sale side of the market have been really kind of a boost to rental demand. But one thing that I think is also a really important trend that's taken off in recent years is that a lot of those folks are maybe still looking at single family homes, even if they can't afford to purchase them. We've seen the single family built to rent segment really explode in recent years. You can see this chart showing 111,000 new single family homes that were completed in 2024 were specifically being built to rent. That was about 10% of all single family homes that were built last year. That's way up from even 5 years ago. So this is a segment that's really growing very fast and presenting kind of new challenges to multifamily, or I should say a new segment of competition for multifamily. We've got more and more of these young adults that are renting later into life, but are potentially still looking for that single family lifestyle. So I think that's kind of an important audience for multifamily operators to keep front of mind is, how can you attract those folks that are maybe renting with young families and are looking to rent into that next stage of life. So those are the headlines. Rent growth still soft, occupancy still soft. We're coming down off of this supply wave, but it's going to take a little bit longer before things really start to shift. Uh, During this period where conditions are a little bit softer and renters have more choices, we're seeing that they're taking their time, but we're also seeing that renters are still willing to compromise, and many are going over their stated budget. So really important to show renters that you're able to give them the things that they're wanting, and if you can do that, then they might be willing to pay a little bit more. And then the for sale market still deadlocked, still presenting a little bit of a tailwind to rental demand, but more of those folks potentially looking at single family homes. So I'll leave it here with a few resources, and I think we've only got about 1 minute left, but if folks want to stay on for a couple minutes, I'm happy to take a question or two.
Hey, Chris. Thanks for all that. Appreciate it. Was curious. One of the questions that came in is DM was earlier in the presentation. You were talking about kind of a shift in seasonality in terms
Yeah.
of. I think right now we're feeling like the busy season is shorter and maybe ending earlier than it has in the past, and it looks like it's kind of bearing out in the data. I know we're at time, so I understand if folks need to log off, feel free. Appreciate your time here, but if you have a couple more minutes to stay on, Chris, we'd love your thoughts sort of on what's happening there.
Yeah, yeah, I mean, I think this is kind of a really interesting thing that we've noticed that's now been about 3 years running, where the fastest month of rent growth is happening earlier in the year. This year it was March. It was actually been March for the past 3 years. Now, some of this I think just has to do with the kind of softness in the market generally, but I think there is kind of a real change that we've been seeing in the timing here too of when folks are moving. So go back to 2020, that all just got scrambled, right? Traditionally, moving schedules are really closely tied to the school year. Also, in many parts of the country, it's unpleasant to move in the winter, and so the spring and summer are kind of the typical times when folks move. But that all got scrambled in 2020, as the pandemic kind of impacted when folks were maybe even able to move. And now what we're seeing is that one-time shock to the timing of when folks signed leases. Well, then that impacts, when your lease comes up for renewal 12 months later. And so that's been kind of a lasting impact, I think, is, as folks have gotten locked into these leases where the timing is maybe a little bit different, now that comes up for renewal at the same time, 12 months later every year. So that's been having a prolonged impact on the market. I think there's also a little bit of some of this maybe being an intentional strategy on the operator side to try to spread out demand more evenly throughout the year. So that's another thing that we've been hearing and seeing too, is that operators are kind of working with non-traditional lease lengths to try to time out those when leases come up for renewal to be a little bit more evenly distributed. So some of that traditional timing and the seasonality of the market is looking like it's shifted a little bit over these past few years, and I think that probably is something that's going to continue.
Great. Yeah, that seems to line up with a lot of anecdotal stuff we're hearing, and it'll be really interesting to see how much longer that kind of trend, whether it persists even as sort of the construction industry starts to slow down and supply and demand start to kind of like rebalance themselves in the coming year. Um, yeah, so with that, we are 2 minutes over. Wanted to thank you again, Chris, for all the insightful information, and thank you to everyone else who joined us today and participated. We got some questions in the chat, but yes, we'll be sending out a recording of this. And yeah, you can see on screen research@apartmentlist.com. That reaches Chris and I directly. We'd love to hear from you if you have questions or feedback or thoughts. Our virtual door is always open, so feel free to send us an email. Otherwise, we'll be back in a couple months with another one of these, and we hope to see you there. Have a good one.
Thanks, everyone.